Hey guys, how we doing? So Dan from Trading with Dan here. So in this video we're going to look at market patterns. So what are market patterns? These are common shapes or patterns that are formed on a price chart. They can help predict the most likely direction the price will go in, and patterns can occur repeatedly as retail traders often repeat the same mistakes. They're not 100% guaranteed to play out, but they have a higher degree of success. Right, so here's one of the common patterns that we get. So as many traders will trade predictably between support and resistance levels, placing stops just above recent highs or recent lows, market makers that want to fill large orders will know to push markets into those levels to trigger those stops and fill large orders before the market then reversing and going in the intended direction. So we can see this here. What we have, the market's moving up, we start to sell off, so traders then start to take short positions with their stop basically just above this high. So then the market makers then think, okay, we want to get short here too. But all the market makers or bigger traders think, right, we want to get short here too, but if we just sell the market now, we're going to get a lot of slippage, we're not going to get the best price. So what we're actually going to do is market buy the market. So push the market up. So they push it above that high. That then starts to trigger the stops that they've got. So those stops are obviously people having to buy to cover short positions. And then obviously some traders will actually go long at this breakout. I think, right, it's continuation upwards, let's buy and go long. Whereas the big traders thought, okay, right, I've got filled my liquidity to go short, and then the market goes down, and they obviously then will keep selling into the market, and the market will keep going down. And then the other short traders, the other people that wanted to get short of the market, then also jump on the back of this trend downwards. Now that they know we've had the stop loss hunt, so here's the same in the opposite direction. So the market comes down. It stops going down, starts to come up, so then traders start to buy this little bounce and just have their stop just below that low there. Makes sense, doesn't it? All sounds fine. So then the market makers, they decide, right, we want to get long as well, and we want to get big positions. We don't just want to buy into this move up now. We're actually gonna sell. We're gonna push the market down, trigger these stops from all the people that bought here, and then we're gonna soak up that liquidity. We're gonna buy all the positions that they're selling as they're stopping out, and then we're going to push the market up. So you can see this is obviously a liquidity pool that we discussed in the last video that you guys would have watched. Right, so how do you trade the stop loss hunt? Right, firstly, don't try and wait for the falling knife, wait for the candles to close. So obviously this is not a candle, this is just a line chart. But yeah, so wait till we've actually stopped falling, so we've actually reached a bottom or a top. So yeah, so then also you want to, I've gone to the wrong one there. So yeah, you want to place the horizontal lines at recent highs and lows to identify those stop loss levels like we saw in the previous example. So if the price looks like it's losing momentum after that hunt, then that would be a good time to enter the trade, and then you would place your stop loss just beyond the initial stop loss hunt area. So, and then you would look to profit at the next horizontal line you've identified. So back to this one. So basically you'd see this happen. You'd wait, you'll see the stop loss hunt, so then you would then buy on the retrace of the stop loss hunt and then place your stop just below here. Obviously they could do another stop loss hunt, try and get more liquidity, push the market lower, and then you could get taken out, but at least you've not been taken out on this one, so you've got a better chance of making money from that trade. So here is an example of how to trade a stop loss hunt. So what we've got here is we've got the market obviously has a trend upwards. So then we've eventually so I'll have some consolidation, start to move down a bit to this level 1, and then it looks like we're actually going to start to push up. So we start to push up, we get to this level, we have a little hunt in this liquidity pool up here. This is obviously initially a stop loss hunt for those people that started selling the market at 0.1. What we did was people sold this market looking like we're going to break down, and then 0.1 we started to then go back the other direction. So we were starting to go back up, and then this is where obviously this is where their stops are going to be, above this recent high here. So anybody that's sold at any point after here, is likely going to have their stop above this level here. So then this is what we get it. We get basically they push us back up to that level. They push us through that level. We trigger those stops, and then the market then comes back down. And then it has a bit of a retrace, doesn't manage to get back up to that level again. It looks like they try to do another stop loss hunt, maybe above that level, but they don't make it, and the price comes all the way down. Like the original people that bought here were correct in thinking the price is now a lot lower, but they got their stops hunted before we got down there. Right, so here is another common pattern in Bitcoin. This doesn't often happen too much in traditional markets, but it is definitely a feature of Bitcoin markets. So these patterns typically occur when the market makes a sudden bullish or bearish move. So like here's a sudden bullish move up, here's a sudden bearish move down, followed by a long period of consolidation. So this is a long period of consolidation, and this is a long period of consolidation. So then what happens is the price will often then just break back exactly the same way it came from. So it breaks down, it consolidates, breaks back up. Then after it's broken back up, it consolidates and breaks back down, and that's called a Bart pattern. Obviously, these patterns can break in either direction, so we could break down, trade along a bit, and then break down again. But often in Bitcoin, they tend to reverse rather than be continuation patterns. So that's definitely something to think about. So why do Bart patterns happen? When price drops or rises violently in this way, it is likely because of a stop loss hunt, a large market order, extreme greed or fear, institutional market manipulation, which is basically a stop loss hunt, or a heavy imbalance in the order book. So then what happens is when the market makes that move, it makes that, say, big move down or big move up, then the buyers and the sellers, they lose interest in the price basically the price at the level it's at. They don't necessarily want to buy or sell it. The people that are long, don't want to sell anymore at this level, and don't want to cover their positions. The people that are basically waiting to buy don't want to buy yet. They're going to wait for a breakout, and then we get the breakout up. So then the people that shorted, then they will cover their position then, which will buy the market up. And then the people that were waiting to go long at the breakout, they will buy into that as well and force even more short covering. So trading Bart patterns. When a price moves with high volatility, it may be best to wait until it calms down. So when the price is settled, you can look for other patterns to identify a trade. So prolonged periods of low volatility can often seem boring, but it means the strength of the buyers and sellers are equal for that period of time. If there's a stop loss hunt, it can then often trigger a move in the opposite direction and then a break of the overall consolidation period. So you can kind of see here we have the move down. Then the market just doesn't do a lot. It tries to move back up, but then gets hit back down again. So it's sort of a stop loss hunt, sort of a momentum buyers tricking them into positions, and the market gets slammed back down again, and then eventually it does break up. But what you do often see in Bitcoin is that the market it fakes in one way and then goes the other way. And that's basically a stop loss hunt to get the liquidity of the big traders to then move the market in the opposite direction with a full size position. Right, so flag patterns. These are another good pattern that do occur in all markets. So a flag pattern. These chart patterns typically occur when the price makes a sudden bullish or bearish move, followed by a short period of consolidation before further continuation in the move, usually in the direction of the original move. They can resemble a flag on a pole. So these are different to Bart patterns, mainly in the respect that it's a lot shorter period of time, the consolidation, and it can often drift counter trend, and then the volume will come back in, the volatility will come back, and will continue in the same direction. Flag patterns are more likely to be continuation patterns. That goes for all markets, and obviously Bart patterns tend to, more often than not, well, obviously if it is a Bart pattern, it has to go down and come back up, but those initial patterns that look like flags, elongated flags, they often do then break up the other way. So here's an example of a number of flag patterns playing out, and then the resulting large drop as higher volatility resumes and the price continues in the original direction of the move. So if you see here, we're getting the move down, so we get this sort of flag pattern. It does kind of, price action just kind of drift up, and then we break back down again. Price action drifts up again, then it sort of breaks down. It breaks out of the flag, doesn't come down much, consolidates a bit more, and then it comes down again. Consolidates a bit more, comes down again, consolidates a bit more, comes down again. And these are typical examples of flag patterns. and how they look on a chart and how to trade them. Right, so how do you trade a flag pattern? When the price moves quickly, it is important to wait for the volatility to calm down. If a favourable setup emerges during the consolidation period, then the trade can be entered with a stop loss placed outside the consolidation range. A short period of consolidation offers a great opportunity to enter a developing trend as long as other factors of confluence support the trend. Note that after a period of consolidation, price may look like it's going to reverse. This can be a stop loss hunt. So basically a stop loss hunt to get liquidity before the market resumes in the original trend. So it can be prudent to wait for a few candles to close before entering a trade in the direction of the reversal. Right, so another pattern that is very common in Bitcoin is this one here. This one's called the descending triangle. We also get ascending triangles, but we'll cover descending triangles first. Right, these are very common patterns in Bitcoin, and they form when mounting selling pressure stops the price from making higher highs, but the demand prevents the price from making lower lows. So as the selling pressure increases with each bounce off the lower support, the supply finally outstrips the demand and the support level gives way and the price drops. The more touches of the base level of support on the triangle, the weaker it becomes, and the weaker the bounces off the support level and the weaker the buying demand is, and therefore the more likely it is to break out. So here is an example of a descending triangle. So as you can see in this example, the price is bouncing, look, and making lower highs, whilst the same bottom level of support remains. So supported here, supported here, supported here, and then obviously this is where it's lost. So when that support is finally lost, we then do get then a big move down. So this is showing that we've got buying here, and then the price bounces, but each time the price gets it bounces by less, basically. So there is less buying pressure, there's less buying strength, and then the selling pressure comes in earlier, basically sooner as with each bounce. So it just forms what obviously is a downward slope to the top of the triangle. So then when this bottom base area finally does give way, there's often a big move down. Right, so the opposite of an descending triangle is an ascending triangle. So again, these are very common patterns in Bitcoin and form when mounting buy pressure stops the price from making lower lows, but the supply prevents the price from breaking the upper level and making a higher high. So as the buying pressure increases with each bounce off the upper resistance, finally the supply the demand will outstrip the supply at the resistance level, and then the price will rise sharply. As more touches of the upper level of resistance, the more touches we get, at the upper level of resistance on the triangle, the weaker it becomes and the weaker the bounces off that resistance level. This is obviously why we get the higher lows, because we're getting a weaker bounce. and that shows us that the price is therefore becoming more likely to break. So here is an example of an ascending triangle. So as you can see in the example, this example is a bit more clear than the descending one. So we can see we've got this upper level of resistance. Price comes up, it meets it, it gets rejected. It comes back and meets it again, it gets rejected by not as much. It then comes back up, meets it again, looks like it maybe is going to break through, gets rejected, and again doesn't get very far down, and it doesn't stay down for very long either, because you can see it's only a wick. And then once we get back up to the level, we then break through and have an explosive move upwards. So here is a diagrammatic representation of it. So you can see price comes down, it gets bought all the way up to there, comes down again, gets bought, but there's not enough buying pressure to get it as high as it was last time. Comes back down again, gets bought here. Again, even less buying pressure, so then it comes back down, and then the bulls that were buying it up, seeing that they're not really getting anywhere, they're not making any progress, the trend is clearly down, they give up, and then the support basically falls away. Opposite happens here, price gets bought all the way up, it hits this level of resistance, it then gets sold into, retraces to this level, and then gets bought back up, hits the resistance again, and then starts to sell off again, but doesn't manage to take out this low. So it then gets bought up again. The buying pressure then sort of gives way, the selling pressure comes in, but only manages to get us down to this level before the buying pressure comes in yet again. So there isn't really much room. The bears are looking at this thinking, we're not getting anywhere with this selling, we might as well just stop out our position, or maybe even go long and buy, and then we have an explosive move up. So yeah, there's a few common chart patterns that we've looked at, guys. So I hope that did make sense to you, how they actually work and what the dynamics that are going on in the market. So thanks for listening, guys, and I'll catch you on the next one.